Finfluencers constantly talk about dollar cost averaging as if DCA is a magic bullet to any kind of investment. DCA into stocks, DCA into Bitcoin and crypto and ETFs, but is DCA really the best investment strategy? Or would you have better returns if you just do one lump sum investment at the beginning of the period that you are considering investing? Well, in this video, I'm going to break down the pros and cons of DCA versus lump sum investing. I'm going to show you the numbers and why maybe sometimes you should actually just go ahead and do a lump sum investing. All right, so without further ado, let's talk about it. My name is Henry. I've been investing for 20 years, and what I do is basically investing every day. I'm the founder of the Henry Wealth Academy, and I'm also the founder of Maverick Capital. It's a hedge fund based in Hong Kong. And I want to tell you that maybe you should often consider doing a lump sum investing instead of DCA. And let me share with you the screen so that you know what I'm talking about. There is a lot of research and a lot of data that shows that lump sum investing is a superior form of investment most of the time. According to this research from Vanguard, in 68% of the time, a lump sum investment will beat a dollar cost averaging. Okay, but what's a lump sum investing and what's DCA? Lump sum investing is basically, imagine you have an amount of money, you receive a bonus on your company, or you win the lottery, or inheritance, and now you have, let's say, $100,000. Should you invest $100,000 immediately now, invest $100,000 in an index ETF, like the S&P 500, VOO, or SPY, or QQQ? Should you invest this $100,000 in one go? Or should you spread it across a few months? Let's say investing $10,000 per month until you invested the full $100,000. And many people on the internet will tell you that you should invest the $10,000 every month doing the DCA. But if you are focusing on returns, statistically, you are more likely of hitting better returns if you do the lump sum investing. So in this case, Vanguard did this study and they checked the returns between 1976 and 2022. And in 68% of the cases, a lump sum investment would beat investing dollar cost averaging over time. Let me show you here another chart that it shows very well the pros and cons of DCA versus lump sum investing. So we have here the S&P 500, and I put here two different strategies, the DCA and the lump sum investing. The first thing that you can see here is that the DCA investment strategy, it returned only 66%. So you invested over this period $10,000. In both strategies you have invested $10,000, and in the DCA strategy you end up this 5-6 year period with $16,000, while in the lump sum you end up with $22,000. And you can also notice that the DCA strategy has less volatility, right? Because you are deploying your capital a little bit every week or every month. And you can also see that the drawdowns on the DCA strategy are much smoother. So you have a 14% drawdown, while in the lump sum strategy, you have much larger drawdowns. So if you are really risk averse, okay, a DCA strategy is probably the best for you. A DCA strategy can also be applied when you're talking about very volatile assets. I have created a ton of trading view indicators that address volatility, but basically if you have a very volatile asset, such as like crypto, Bitcoin, or certain stocks like Tesla, Palantir, Nvidia, they are quite volatile, and the DCA strategy can smooth out that volatility. But when you are talking about index ETFs, like the ones that we see here, well, even with some volatility and some drawdowns, the lump sum strategy will beat the DCA strategy. So this period that we see here from 2020 until now is the perfect example, because let's look at the chart here. So in the DCA strategy, you have much smaller drawdowns, okay? But if you are a long-term investor, and in this case we are looking at a 6-year period, you started investing a lump sum investment in 2020, and right after that you will have the pandemic crash. So you have a 32% drawdown. Oh my god, this is the end of the world. No, not really, because after that, in 2022, you have a 26% drawdown, and then in 2025 you have an 18% drawdown. And still, at the end of this period, you have much better returns than the DCA strategy. Again, as you can see here, the DCA strategy delivered 66% return, while the lump sum delivered 121% return for the same period. So if you can stomach the volatility, in most cases, you are better off by doing lump sum investment, again, for long-term investments. So let me know in the comments whether you prefer a DCA strategy or a lump sum strategy, and what kind of investments do you do with these strategies. If you enjoyed this video, check the link to the Henrique Wealth Academy in the description of the video. I have a ton of daily content on how to be a better investor, long-term investor, and I explain everything. How did I retire at the age of 39 in Hong Kong, one of the most expensive cities in the world. Anyway, if you enjoyed this video, give it a like and subscribe, and I'll see you in the next one.